Amid the global enthusiasm surrounding artificial intelligence, an increasing number of experts are sounding the alarm. According to critics, the AI industry shows clear signs of a speculative bubble comparable to the dot-com boom and crash of the early 2000s. Massive capital inflows, soaring expectations, and weak profitability raise the question of whether markets are once again running far ahead of reality. One of the core concerns is financial sustainability. Even flagship companies remain unprofitable. OpenAI, one of the world's leading developers of large language models, is frequently cited as an example of a company that spends far more than it earns while scaling at unprecedented speed. Investors continue to fund losses on the assumption that future dominance will justify current costs. Skeptics warn that this model depends almost entirely on optimism rather than proven cash flows. Several prominent business leaders openly compare today's AI enthusiasm to past bubbles. Jeff Bezos, founder of Amazon, one of the largest technology companies in the world, has stated that artificial intelligence resembles the industrial bubble of the dot-com era. According to him, investors struggle to distinguish good ideas from bad ones amid the hype. At the same time, he stresses that AI is real and will ultimately transform every industry, even if many current projects fail. A similar warning comes from David Solomon, chief executive of Goldman Sachs, one of the world's most influential investment banks. He emphasizes that markets move in cycles and that periods of rapid technological acceleration usually lead to excessive capital accumulation. In his view, large amounts of money will be invested without producing returns, and a market correction within the next 1 to 2 years would not be surprising. Another risk lies in capital allocation and infrastructure. Billions are being poured into data centers and specialized chips with long amortization horizons. Karim Musallam, chief investment officer at Selwood Asset Management, argues that if these assets were depreciated, more realistically, profits across the sector would look far weaker. He also highlights rapidly rising electricity prices and warns that energy constraints could undermine the economics of large-scale AI deployment. Concerns about financing are reinforced by Patrick Boyle, co-founder of the hedge fund Palomar Fund and a visiting professor at King's College London. He points out that OpenAI remains loss-making, while infrastructure providers increasingly rely on debt secured by hardware that may quickly lose value. This creates what he describes as a system leveraged on optimism rather than stable cash flows. He draws historical parallels with unused fiber optic networks in the early 2000s and overbuilt railways in the 19th century. Beyond finance, critics also warn of labor market disruption. Christian Klein, chief executive of SAP, one of Europe's largest software companies, argues that it is an illusion to believe AI will boost productivity while leaving the workforce unchanged. Many current professions will shrink even as new roles emerge. The most radical warning comes from Geoffrey Hinton, a pioneering AI researcher, often called the godfather of artificial intelligence and winner of the 2024 Nobel Prize in Physics. He argues that AI will replace routine intellectual labor in the same way machines once replaced physical work. According to Hinton, one person assisted by AI can already perform the work of many, making the hope of painless job transitions increasingly unrealistic. Even insiders acknowledge the dual reality. Sam Altman, founder of OpenAI, admits that investors are overly enthusiastic while still calling AI the most important development in decades. Bret Taylor, chief executive of the AI startup Sierra, similarly argues that AI will create enormous long-term value while destroying capital in the short term. The conclusion is familiar. Artificial intelligence may indeed transform the global economy, but when expectations outrun economics, bubbles form. Some companies will survive, others will disappear, and the industry will eventually emerge leaner, more disciplined, and closer to reality.